Hi folks, and welcome back to Meaningful Money.
Thank you, Ellie, my 11-year-old daughter there, insisting on being a part of this episode. I'm sure you don't mind. Back here at St. Loy on my log. It's ages since I've been here, so it's like coming back to the early days. Now we're talking about success factors. So these are the things which can make or break your investing success and therefore your financial planning success, really. These are the things that if you get right can make all the difference, but if you get wrong can really hijack whether or not you achieve your aims, okay? So we've talked about time, we've talked about cost, and so this is number 3, and this is risk. Now I have talked about risk before. I'm just going to sort of extend that a little bit in the context of these success factors. But before I go in, obviously it remains always for me to say thanks to Seven Investment Management who sponsor the show. So thank you to you guys in London for your continued support. Now, risk, as I say, if you get it right, it's fantastic. It can work for you. If you get it wrong, it can work against you, just like all these success factors. The sort of starting point, if you like, is that if you want any kind of return at all on your money, you're going to need to take some kind of risk. If you just put your money under the mattress, clearly it's risk-free, except that somebody might break into your house and nick it all, but you will get no return on it. You know, you put 100 quid under your mattress and go back to your mattress 1 year later, it's still going to have 100 quid in it. And in fact, it'll be slightly worse because inflation will mean that 100 quid will buy you slightly less a year on than it did when you first put it under the mattress. So if you want any kind of return at all, you're going to need to take some kind of risk. So what we need to do is to understand the types of risk so that you know what you're dealing with and can make good decisions. So the main types of risk when it comes to investing particularly are the risk that the stock market might go down, the risk that inflation might erode any returns that you get or the benefit of any returns that you get on your money. What about perhaps political instability or natural disasters might impact sort of the world economy so much that it affects your investments and your planning. But managing risk is always a sort of a trade-off between the return that you want to achieve and the risk that you're prepared to take to get that return. And sort of managing that trade-off is a skill really, but it's simpler than you think it is. But as ever, you know, a good financial planner will help you make good decisions. So if you take your sort of basic asset classes, the things that you can invest in, equities or shares, if you like, are historically, over the last 30 years anyway, they have provided historically higher returns, right? So you will have made more money investing in shares, but it's also much more volatile along that path. So you will have had to have suffered short-term setbacks, okay? Times along the way where your money has actually gone down in value. So you would have had to have been prepared to accept that in order to get the returns that equities bring. So equities generally produce higher returns than bonds, say, but the trade-off is a high return. Bonds themselves generally perform higher than cash in the bank would, but there is still risk with bonds, more so than money in the bank. So it's always about trade-off, right? So here are 4 things you need to think about when it comes to risk, things to get right, okay? The first thing is to define your goals and your time frame. Now remember, the mantra here on Meaningful Money is that money is not an end in itself, it's there to help you achieve whatever your goals and aims are. And if you know what those goals are and you set a realistic time frame, you are less likely to be fazed by the ups and downs, the short-term ups and downs of the stock market, because you've got a clear end in sight. If you know, it's like anything. If you're looking sort of into the distance, looking ahead, what happens in the sort of very close to you is less relevant in light of that long-term aim. So knowing your goals and knowing your time frame will help you hold your nerve when things are looking rocky in the short term. And if you know your goals and you know your time frames, you can invest accordingly. Now I mentioned this last time, or time before I think, when we were talking about time, the first of our success factors. If you've got a short-term goal, then you keep your money on deposit in cash in the bank where it's safe and can't lose value. If you've got a long-term goal, then you can afford and you should take more risk because you've got time for those risks to play out and to benefit from the greater returns. If you've got a medium-term goal, then you should have a bit of both, right? Balance. So knowing your goals and knowing your time frame will inform your risk taking, okay? And a good planner or advisor will help you with that. Secondly, it's sort of a golden rule really. You should only ever take the minimum amount of risk necessary to achieve your aims. So I have clients that I've spoken to where, you know, they've pretty much made it. They've got all the money they will ever need. And when they then say, you know, I think I should invest this money and make it work harder, you know how much I hate that phrase. My question back to them is always, why on earth would you want to risk it? If you've already made it, achieved everything you want to achieve and got as much money as you will ever need for the rest of your life, why would you risk it? Okay? Now some people still do, and that's their prerogative, it's their money, not mine, but always take the minimum amount of risk necessary. Okay? Thirdly, you need to be able to sleep well at night. Okay? So, how might that affect your decisions? Well, if you have a real lofty goal, some real sort of high target you want to achieve for your money, like, you know, buy a £15 million super yacht in 5 years' time, well, you're going to have to take some pretty serious risks to achieve that, probably. Depends on your circumstances. But if those risks would cause you lost sleep and worry, well, you need to reduce your lofty goals. You need to come up with a more realistic one and instead just buy a £12 million super yacht instead of £15 million one or whatever. But your ability to sleep at night and to relax in the knowledge that your money is in the best place for what you want to achieve is really, really important. In my job as a planner, I have to sit across people's kitchen tables and tell them how their finances are doing. Now, I want to be able to sleep at night as well, so I live by this mantra: take the minimum amount of risk possible and make sure you can sleep at night. It informs your investing, and if you can set limits to what you're prepared to lose along the way towards your aims, then you'll sleep at night, and that's really important. And finally, another golden rule when it comes to managing risk is diversification. We've talked about it before. Spread your money around, so different types of assets, shares, bonds, you know, property, gold, gilts, all these things. Also diversify in terms of geography. Don't, for goodness sake, just invest in the UK. We're a pretty tired old economy, really. There's plenty more exciting places to invest as long as you know what the risks are. Okay? So define your goals and your time frame. Take the minimum amount of risk necessary. Make sure that the way you invest means that you can sleep at night, and diversify. 4 ways that you can make sure risk is working for you rather than against you. Okay? So next time we're going to deal with the last of our success factors, and it's a biggie. It's emotion. How your emotion as an investor can make or break your financial planning. So from St. Loy, thanks very much for watching, and I'll see you next time.